Bobby, I'm sorry, I don't buy it. Recent strength, I mean, you have Saudi Arabia, which in OPEC Plus should be putting more oil on the market next year. There's debate on how much they're actually going to be able to rein in any more production. You got Cushing storage climbing again, nearing record highs. Where's the strength coming from?
Well, we've been working through inventories, and I think the expectation typically is that global oil demand follows GDP. And with expectations around improving GDP in the first and second quarters of 2021, I think broadly speaking, the expectation is that oil demand will follow. Now, if we have a real slowdown here related to a new wave, if you will, of COVID, that may call a lot of that into question. It may slow down our ability to work through these inventories. But at the end of the day, global oil demand is highly likely to follow GDP growth.
Okay, so that's a story for next year, Bobby. Let's talk about what happens over the winter. We've talked to a number of doctors over the last few days who are really painting quite a grim picture, and they are expecting things to get worse before they get better. Do you think that the glut could get significantly worse over the winter? If that does turn out to be the case, what is the downside? I got Brent at 44, I got WTI at 41. Would you say in the near term the risk is to the downside or the upside on those prices?
It feels to us like near-term risk, if you're talking the next 2 to 3 months, is probably fairly evenly balanced to both the downside and the upside. A lot depends on what happens with the vaccine and the distribution of the vaccine and how quickly all of that comes into effect. So, yeah, might we see weakness here over the course of the next 2 to 3 months? Sure. On the other hand, we have worked ourselves nicely through excess inventories. Globally, supply is lower and likely will continue to be relatively flat. So it's just a question of timing. Really, our expectation had been that it would take through sort of the second half of 2021 before we got back to a more normalized price of around $50 WTI. A real kind of slowdown here in the economy associated with a new COVID wave could push all that out a bit. That wouldn't be particularly surprising to us if that happened. But if it pushed it out, it's likely to push it out just into the first half of the following year.
What I find interesting today, Bobby, is that some 2022 months are flipping into backwardation. So there's a little pressure on the back end of the curve. And I wonder what that was about. I wondered if that was lack of demand, if it was hedging, or if it was we're just expecting more production to come back in the next couple years. And if that's the case, what are the best trades to capitalize off of that, considering the prices then could be a little softer?
Well, you have to distinguish between commodities for starters. We're talking about oil here primarily, and oil, of course, is the primary mobility fuel. So to the degree that mobility continues to be restrained, both on land and in the air, it seems quite possible that we could have downward pressure on oil for some time. The flip side of that is that what we've seen in Asia as they've gotten past the worst of the pandemic is that oil demand is back to pre-pandemic levels. And so at the end of the day, this is all highly tied to getting things back to normal. And so the bet here is whether we're close to getting things back to normal or whether we're not. Now, there's a separate question around what secular changes might there be for global oil demand, particularly in mobility and particularly in jet fuel. That all remains to be seen.
How do you think that one's going to play out? Because that's exactly where I wanted to go. I regularly ask CEOs what they think their spending budget next year is going to be on travel. 30% down, 40% down, 50% down are not uncommon answers. And they think that some of this is structural. They've got used to using video conferencing, etc. Do you think we understand fully the parameters of what is going to happen here? And do you think the industry has fully factored in these changes?
In our conversations with executives in the airline industry, their expectation seems to be that leisure travel will rebound quite nicely through 2021. But business travel may take much longer to get back to pre-pandemic levels, if it gets back there at all. Remember, however, that jet fuel is a relatively small percentage of total global oil demand. So even if we have weakness in aviation fuel demand for the next year or two, that by itself is not likely to ultimately set the market, if you will, for oil. Oil is relevant to so many pieces of our economy, whether it's chemicals and petrochemicals, to general industrial processes, to diesel and gasoline demand. So jet fuel matters. It's an important part of it, but it's certainly not the only part of it.
Bob, we have like 30 seconds left. What's your top pick right now, a top trade?
We love Chevron. It's a fantastic company that's performing particularly well right now, really kind of threading the needle for what their shareholders seem to want, which is to say to be able to generate excess cash, and then return it to the shareholders in the form of share repurchases and dividends, while at the same time providing some nominal level of overall production growth. It's a great company, and we like it very much.